Hi guys, lesson for today is lesson number 1, chapter 29, economic growth. So in this lesson we are going to look at the real gross domestic product (GDP). The first part on the defined GDP and what is GDP is all about, and then next we're going to look at these three methods of calculating GDP, which are output method, expenditure method, and income method. Three different method in GDP calculation. Then we're going to look at the real GDP versus the nominal GDP, as well as the per capita GDP per capita, or GDP per head. All right. So let's get started with the lesson. So instruction for students. Students are required to read, watch, and do. Read Econs Course Book page 250 to 253, as well as the attached notes given here. Watch video presentation, this video presentation. Do multiple choice questions in Econs Course Book page 258 and 259. By end of this lesson, students should be able to define gross domestic product, which known as GDP. Describe methods of calculating GDP. Three different methods or three different approaches, which are the expenditure method. Expenditure method is the GDP is equals to C plus I plus G plus net exports. All right. And output method by adding up all the outputs or the value added of the three important sectors, which are the primary sector, secondary sector, and tertiary sector. Three sectors. By taking the sum of the value added outputs of the three sectors, you'll be getting the GDP. This is what we call the output approach or output method. The third method is the income method. Income method by summing up all the rewards of the factors of production or the rewards of the economic resources, which are the reward for land is we have four important resources, economic resources or factors of production, which are the land, labor, capital, and enterprise. Reward for land is rent, reward for labor is wages, reward for capital is interest, reward for enterprise is profits. By adding up all the rewards, you'll get the GDP in a country, right? And finally, you should be able to calculate the real GDP and real GDP per head. So you must know how to convert to real GDP from nominal GDP. Yeah. So introduction. In defining GDP, you must know GDP means gross domestic product. So it is the sum of market value of all final goods. It's not it's not unfinished goods. All right. Here in this case, market value. GDP is known as the market value of what? All finished goods and services produced by economic resources located locally within the boundaries over a period of time. All right. Or all economic resources that are located inside the country that produce the finished goods. Right. So GDP means the market value of all final goods. All right. There are two types of goods: finished goods and unfinished goods. All right. So GDP does not include those unfinished goods. It only includes those finished goods. Unfinished goods means intermediate goods. Finished goods means the final good, which is ready to consume. All right. So GDP means a GDP can be defined as the market value of all final goods and services produced by economic resources located within the boundaries of a country over a period of time. Right. So methods of calculating GDP, there are three different methods which give you the same value of GDP. The first method is the most commonly known expenditure method, which is the C plus I plus G x minus M. So it is the same formula as the aggregate demand, right? Aggregate demand is equals to C plus I plus G. Net exports x minus M is the same thing. The first one. The second one is the output method, is by adding up all the output of the three sectors, which are the primary sector, secondary sector, and the tertiary sector. Finally, the income method will be the sum of all rewards from the economic resources. All the rewards from the economic resources. We have 4 different types of economic resources. These include land, labor, capital, enterprise. Reward for land is rental. Reward for labor is wages. Reward for capital is interest. Reward for enterprise is profit. So by adding up rent, wages, interest as well as profits, in the entire country we can get the GDP. That will be the income approach or income method. So let's take a look at the expenditure method. In this method, GDP can be calculated by adding up all the expenditure on the country's final goods and services. We have 4 different sectors in an economy. We call it as 4-sector economy. The first sector in the economy is the household sector or consumers. We usually call it as consumers or household sector. That is the first sector. 2-sector economy means household together with the firms or the private sectors. Household and firm will be the 2-sector economy. The 3-sector economy is what we call household, firms together with the government or the public sector. So household, firms and the public sector. The 4-sector economy will be there together with the external sector, which is where we can say like household plus firms plus public sector plus external sector will be the 4-sector economies. Therefore, expenditure by each sectors by adding up expenditure from the each sectors, we can calculate the GDP. Like for example, household sector involved in consumption. Consumers they involve in consumption. Private sector or firms involved in what? Business expenditure or investment. Government or public sector involved in what? Government expenditure. External sector is what? Net exports, where exports minus export expenditure as well as so export revenue and the imports expenditure. So by taking the sum of all of these, which are the consumption, investment, government expenditure and net exports, we can calculate the GDP. For example, if we take a look at the diagram here, 50 plus 20 plus 30 plus 20 from the net exports, where export is equal to 80, imports is equal to 60, net exports is export minus imports, 80 minus 60, we get about 20. So by adding up the 50, 20, 30, 20, we'll be getting about 120. Next is the output method. If you look at the output method, output means is production. Output means production or products. Refers to the process of transforming input into output. So firstly, we look at what do you mean by the value added. Value added means what? Value added means the sales of output minus the purchase of inputs. Sales of output minus the purchase of inputs, where the output means the process of add value to the output. So conversion from input to output means is a process of adding value to the output. For example, a baker buys inputs such as flour, eggs, sugar and other items, let's say at a cost of $20. Then he or she processes it into a cake which is sold, assume at the price of $80. Therefore, you can see the sales value of output is $80. The purchase value of inputs is $20. Therefore, the value added to the cake is about $60. So value added equals to sales value minus the purchase value. Hence, the output method measures the GDP by adding up the value added created by various economic sectors over a period of time. So we can see the economic sectors by output. We have primary sector, secondary sector, tertiary sector. So value added from the primary sector plus value added from the secondary sector plus value added from the tertiary sector, we can get the GDP, which is going to be the same value as the expenditure method. No matter expenditure method, output method or income method will give you the same value of GDP. So let's take a look at the third method, which is the income method. In this method, national income or GDP is measured as a reward of factors of production. Rewards for factors of production which are engaged in producing national output. So in the income method, GDP includes all the income which have been earned in producing the country's output. For example, you can say the factors of production, or another word for factors of production is economic resources. We have about four components of the factors of production, which are land, labor, capital, and enterprise. So the reward for land is rental, reward for labor is wages, reward for capital is interest, reward for enterprise is profit. So by adding up all the rentals, wages, interest, and profits earned in a country, the country level or macro level, will give you the total of the GDP using the income method. So you can see here 20 plus 60 plus 10 plus 30 will give you the same value of the 120. However, in income method, transfer payments are not included in the national income calculation. Transfer payments such as welfare payments by the government to the society, unemployment such as the unemployment benefits or pension are not considered productive in the GDP calculation, are excluded in the national income calculation. So let's look at the important parts of nominal GDP versus the real GDP. Nominal means inflation. Nominal means nominal includes the inflationary effect. Nominal means the current GDP. Nominal GDP means the current GDP, whereas the real GDP is what? Deflated nominal GDP. Deflated nominal GDP is the real GDP. The value of GDP may change over time due to changes in the prices in the respective operative years. So the operative years can be distinguished as a base year, constant price, as well as the current price. Okay, if GDP at the current price, meaning to say nominal. If the GDP at the constant price, meaning to say real GDP. So in other words, real GDP means GDP at the constant price, following the base year price, whereas the nominal GDP means following the current year price. Okay, so look at the GDP whether it is a current year or a constant year or base year. If it is from the base year, we call it a real GDP, whereas current year GDP will be the nominal GDP. So nominal GDP or money GDP refers to the output value which is calculated based on the current prices, which is expected to be higher due to what? Inflationary effect. If you look at the real GDP means output value which is calculated based on the constant prices, which has been adjusted nominal. It is an adjusted nominal GDP where it includes the inflationary effect from the GDP. To convert nominal to real, we make the consumer price index. We make use of what? Consumer price index. So for example, the formula to calculate real GDP is CPI, consumer price index, in the base year divided by the CPI in the current year times the nominal GDP. Okay, let's assume the nominal GDP is equals to 240 billion, whereas the base year CPI is about 100, and the current year CPI is 120. So we can calculate the real GDP by taking the base year CPI 100 divided by the current year CPI 120 times with the 240. You can get the real GDP, which is about 200 billion. Right, next, real GDP per head. Real GDP per head is what we call, another name for real GDP per head is real GDP per capita, per person GDP. So income per person, it is what we call as the income per person. Income of a Malaysian, for example, if you calculate the real GDP of Malaysia, therefore Malaysians per Malaysian's income, GDP per Malaysian, GDP per head, GDP per capita is measured by dividing the total real GDP at a particular year by the country's population. Okay, so real GDP per head can be calculated by taking the real GDP, the total value, divided by the total population of the country. So for example, look at the illustration. Let's say real GDP is 300,000 million, and the total population is 20 million, for example. Therefore, we can calculate the real GDP by taking the 300,000 million divided by the 20 million. You get about $15,000. So therefore, real GDP per head of $15,000 is an average of per person income in the country over a period of 1 year. Therefore, real GDP per head is the measure of standards of living in the country. So that's all for today. Thank you very much.